We're going to be talking specifically about equity markets. We're going to be talking specifically about the current state of the market, the Magnificent Seven, and whether or not we are potentially right now entering a bubble. And most importantly, what that means for how we navigate the markets. This right here today is a check. It is a check to make sure that not what we've seen transpiring over the last 4 years, over the last 2 years, that over the last 6 years, going back to, I remember December 2018, markets corrected fourth quarter. Since then, it has been basically a free ride. But to make sure that going forward, we are on the right side. Did I send, Aldo, did I send you to the wrong stream? No. My bad, my fault. I was wondering, it's like, we're a little light in here. Listen, I'm going to have a lot of fun in today's session. It's going to be very informative. I think you're going to love it. I put out in the announcement channel, it was going to be a fantastic session. And that it is going to be, that's coming off of yesterday's session, was super fun as well. You know that we often talk about the markets are not crashing. Zoom out over here, give some perspective over here, and like help people out. Like, because people's, let's say, instinct is always to look for the crash. And what you want to do is you want to get on the right side. That's why we talk about the markets are not crashing. And then I like to talk about, well, when they are, I hope that we're on the right side. And we've had two opportunities over here. We had the great global lockdown crash, and we were early. We were on the right side. We executed perfectly, even talking about moving into holding these positions and pushing them. The downside is normally not easy to trade at all. This was a very, very, very easy downside to trade. Craig, I'll go ahead and I'll send those out to everyone after the stream over here, just so that they have today's link. And then over here, we did a good job navigating the bear market for sure in 2022, making sure we are on the right side, and then actually finding the very, very bottom and confirmation of that. Very, very well handled. I hope that the next time the market's correct, that we're able to navigate that. People always are reminded of the lost decade over here, coming out from the dot-com bubble burst. And this is, a lot, let's say, a lot, it was a lot more difficult to navigate in real time for a lot of people than the recent corrections we've had. I call them corrections, not crashes, because they've been very short-lived and abrupt out. Yes, most macro people got this wrong, both into the correction and then on the way out, looking for insolvency events and taking out the lows. But we're talking about our generation, the way that we've been able to trade it and navigate it. And same thing over here. Most people, not all people, but sentiment was incredibly bearish. Most people were not looking for the turn as the turn came. I have to be honest, that was a close your eyes type moment. And it's important to be reminded of that, because at any point you get a big technical breakdown, it's normally a close your eyes type moment. Same thing with the breakout to the upside. It's normally a close your eyes type moment, because it's normally happened when the least amount of people expect it. We don't want to be, this is like a simple trend line. And simple trend lines are awesome. Why do I say that? What am I talking about? I got to get the brush up. I don't like orange. You like the orange? Maybe we go a little bit more Bitcoin color. We've been talking about Bitcoin a little bit. Should we do red? Watch out. Alert. We're green. The markets are not crashing. We're going to go green right now and keep going over here. CTM strong. Everyone, glad you are here. It is good that you're here. This is a simple trend line break that we're looking at right now. And again, this was a simple trend line break. This was a simple trend line breakout. Come over here, and I think we had, I guess that's all we could do. That's fine. This would be late. This is about 18%, 17% from the all-time high. Bear markets normally confirmed about a 20% drawdown in equity markets. We want to not be caught off by surprise, which is why we're watching things like this. This is obviously a potential Wyckoff distribution taking place. Does that mean just because we're watching it that it's happening? No, we don't know. We're watching just to make sure we get it right in real time. This would be obviously that green line would be the trigger for the next move down. That would be the earliest possible sign that we are looking at and headed for a larger correction and breakdown. If it's happening, I want to be there. You can't see the pointer color? This is a travesty. What is going on? There we go. Thanks, Ace. Appreciate that. All right, now we're good to get going. Let's get into the session. And I want to start off with this right here. This is, I just saw this yesterday come up in the afternoon because TXMC was able to go ahead and retweet it. And this post is talking about this guy, whoever this guy is, Michael Cantra. By the way, over here, this is so important. This is in relation to Bitcoin we're talking about right now, but it's all the same trade. It absolutely relates to equity markets 100%. Last week, I joined the Bitcoin space to learn. Nothing like being early to Bitcoin. And inquired about what the various risks to price were in the asset. I didn't get much feedback. One thing I think is relevant to add to the conversation is that regardless of review, one has to appreciate and acknowledge that Bitcoin, as well as risk asset, including equities, there you go, have enjoyed 2 years of massive pricing out of risk via tightening and credit spreads. It will be interesting to see what happens to Bitcoin in the next backdrop of widening and spreads. I mean, great, late to Bitcoin. So obviously late to understanding the risks in Bitcoin and late to maybe understanding that Bitcoin is highly correlated to risk. If you remember, I remember, well, this was yesterday morning, actually. Yesterday morning, before this post was crafted, I sent out a note in the macro channel, was like, Luke, who pays close attention to credit spreads, how are we looking? What's your read? This is coming off a Zero Hedge article that credit spreads send a warning for stock investors. Stocks are close to the most overvalued against corporate credit spreads in treasuries in about 2 decades. Luke went over here taking a look over, and you could see this is only going back now 8 years, but you could see the lowest level in 8 years going off of the Zero Hedge highlight over there, saying going back 2 decades. And in the past, when you've seen these low levels, you've then seen credit spreads begin to blow out. And in those occurrences, we are looking at markets under pressure. Now, this is something that we're not new to Bitcoin. This is not something that is new news to us. This is something that we watch closely, which is why that we were already watching it and taking a look at it. Junk in a bit more of a potential dangerous position, Luke pointing out. And then I like this chart from TXMC, who just zooms out and shows you credit and liquidity. And you can see that each time it goes out, Bitcoin under pressure. Here's the peak, it going out. Here's the peak, it going out. Here's the peak, it going out. Again, nothing new to us, but something we watch. And as other people are beginning to watch, these things are very hard to time. In hindsight, it's very easy to know when the turn happened. Remember, very few people caught the turn right over here. Very few people did. Very few. I'm not sure. I think most people did a good job for the bear market. I think in 2022 is very clear that the Fed was entering into a rate hiking phase. I think most people got it right. I think so. This was very quick and easy. Most people off guard. At the bottom, remember, most were late. It took to the summer of 2020 for most people to finally realize it was up only. In April, CTM was forbidden, tongue in cheek, from selling, and it was buy only, up only. You could even see the relation here we just talked about, where I was just talking about the fourth quarter of 2018 and the correction. And then you could see that's when Bitcoin dumped, and the tight correlation and relation to all of these. And there are concerns. This could persist for a lot longer. As you look at credit spreads, stocks most are overvalued against corporate credit, that could continue to persist, and it could persist for a pretty long time. Who knows? But don't forget, no one's talking about it. I just want to remind everyone we are looking at sometime later this year into next year, commercial real estate market becoming an enormous problem for the market to digest. Not to mention, if yields continue to remain elevated, is going to be an even bigger problem. There's lots of worries, including liquidity. Right now, we're looking at a phase when it looks like the Treasury is getting ready to release their stockpile in the Treasury general account, which should be conducive for liquidity. And after that, they're going to be go ahead and I'm sure issuing new issuance once again. That winds up being supportive of markets. But as we look at the reverse repo markets, we see that they are getting close to being drained, more pressure on the markets. My view is that the Fed is going to be preemptive and act sooner than expected. I'm not talking about outright QE, but the balance sheet is going to go from contracting to expansion. That's the next phase of the Fed cycle. That's what I'm watching, but I don't know that that's going to be right at all. What I'm trying to point out, there are some risks into the market. Why did I have this slide up here next? I'm not sure. I think it's one out of place. I guess I'll just come back to it. Let me start over here and continue over here. Magnificent Seven equals invincible. Speaking to some people over the weekend, and then you have these I don't know, I guess we'll call them high net worth money managers. And the best advice they could give anyone right now is to invest in the Magnificent Seven. That is the advice that each and every one give, because honestly, not much is outperforming that. Again, this is more along the lines of passive investment, high net worth individuals, and no one really wants to be left behind. And a lot of people actually, even with the markets up in the last 2 years in a mega bull market, are still underperforming. If you look at, by the way, we looked at altcoins and we talked about going back to 2021. And we showed, remember, things happen a lot quicker in crypto than in the equity markets. But same concept. We were looking at how only a handful out of the top 50 altcoins in 2021 were still in the top 50 today. History shows giants can stumble. Only 6 of the top 20 companies from 2000 remain in the top 20 today. Now, you go back and it's pretty good. If you go back to the dot-com bubble when tech was just emerging and you look at who was there and you see Apple, Microsoft, right? Now, if we look at obviously in the FANG, we'd also be talking about Amazon. We would be talking, probably wasn't in the top percentage of the weighting though, for sure. Probably just made, well, anyway, I digress. Point being, what everyone is focused and biased on today might not be the leader tomorrow. This is going to be very important as we continue to look at how we're currently navigating and just checking to make sure we're not caught off guard by anything whatsoever. I can't remember why I have this slide here in relation to the conversation. So we're going to come back to it right after. We're going to come right back to it. But let me keep going. Lessons from history. This is, by the way, coming from Howard Marks. He just released a new memo. Here's a summary of it. He's talking about what is a bubble, right? Key signs. No price too high thinking. Not even concerned about valuations. FOMO driving investments. Blind faith in this time is different. This is a big one. So he warns optimism can morph into dangerous euphoria. 3 stages of a bull market. Let's find out where we are right now. Few believe recovery is possible. That was the beginning of 2023. Improvement gains broader acceptance. That was all of 2023. Everyone is convinced things could only get better forever. I'm not seeing that right now at all. I'm seeing a lot of concern. And I actually, we see both sides all the time. So there are people who remain bearish over the last 2 years on like one of the greatest runs of equity markets in history. 2 years, S&P 500, back to back 20% gains. It's only happened 3 other times. And there are many people that remain bearish. There's no question about it. But today, where we sit right now at this particular moment, I think that right now, a lot of people are definitely very concerned about the overall picture and where we are today. So I don't think everyone's convinced things could only get better. That does seem like, to me, the first quarter of 2021, right? For sure. Lessons from history. Bum, ba-dum, bum, bum. So AI today mirrors past fads. Does it or doesn't it? Let's check it out. Tech in the 90s, Nifty 50 in the 70s, and often new blinds us to risks. Now, people are talking about the AI and whether or not we're in an AI bubble and in relation to the dot-com. Remember, the dot-com bubble was the internet was basically entering the mainstream. No one had any idea what it meant, and Wall Street was just throwing money at it and asking questions later. But the internet obviously did change the world in a drastic way. And I believe AI is absolutely headed in the same direction. You have people out there, pumping their bags. Like today, Elon is talking about, the advance of humanoid robots and how everyone's going to want one. And, AI and these humanoid robots are absolutely connected. It is actually like the brain functioning behind those humanoids, these AI machine learning computers. And I think personally, in much the same way, the internet was not what everyone expected, or during the dot-com bubble, it wasn't the infrastructure companies that were going to win out, right? What it wound up being was that the internet basically helped every single business there is continue to make massive advancements. Same thing with AI. Likely, like the main use case for AI is that you, in your work, in everything that you do, in everything that you do, even scheduling your social calendar, your kids' school calendar, commitments, everything, planning, vacations, trips, everything. And then, of course, every sector is going to embrace this. And that's massive, massive, massive upside growth, not only for the quote unquote AI sector, but also for everything at large, much more efficient, much more adaptable. Let's keep going. Lessons though, FOMO applies to bubbles, right? And everyone feels the need to jump in. We're not looking at that right now at all. The lessons: beware of herd behavior. Love CTM. We're always away from the herd. AI will change the world today. Is the rallying cry much like I already addressed this, and I don't think it is. Overestimating potential leads to overpricing. We did see that recently and this is a very important piece of the conversation. We saw that with quantum computing a couple of weeks ago. Alphabet released some milestones that they have achieved, and all of a sudden you saw these quantum computing stocks jump. And then we saw yesterday Jansen put take them off 50%, 50% drawdowns instantly by saying, we're at 15 to 30 years away, right? But the thing about, and this is important in relation when we get into where we focus and whether or not we have a blind spot, this is a session to protect ourselves and help us going forward to make sure that we continue to be on the right course. Don't forget, like if you're in a boat, right, and you're setting your coordinates, and let's say it's like 200 nautical miles away, and you're off by 1 degree, by the time you arrive, you're going to be so far off, it's ridiculous. So right now we're just making sure in real time that we continue to be exactly where we need to be. So just, you have to be able to take this portion of the conversation and then we'll insert it later. But one of the beauties of things that we trade, whether or not it's like FNGU or TQQQ, is that these are always being adjusted in much the same way, right? You just saw, for example, Bitcoin here hitting 100K, MicroStrategy, company that's embraced Bitcoin, they're just added to the NASDAQ 100. And if at any point in time there's a quantum computer company that, like, I'm thinking about future innovation, or some household nuclear reactor company, right? Whatever the case may be, whatever's happening tomorrow that's leading the way, that's inserted. So it's not like we're picking, pets.com, and if pet.coms fail, we're in the wrong area. We've placed ourselves between Bitcoin, crypto, and tech in the right area, right? And this is just looking at the four that we traded over here. I think I will come back to this when we talk about bear markets. All right, that's what I'll do. I'll come back to that in bear markets. By the way, this is a sign that this is worrying. BlackRock saying the world economy has exited the boom and bust. What's happening to China right now? Is China booming? I don't know. I'm a little confused by that headline, actually. So betting on the leaders assumes decade of dominance. One of the things we've done to protect ourselves is actually focus on buy side only on instruments that are constantly reallocating themselves to who the leaders are. That's very good. That's very good. So some of the worries about froth in the market, Magnificent Seven's dominance, I think that's a big concern. We'll look at that in 1 second. At the same time, I think the Magnificent Seven and tech is leading for a reason. And you could go back to the dot-com bubble, and not just the bubble, what happened during the facing reality stage of the early 2000s with tech. And if you look at companies like Apple, if you look at companies like Amazon, Meta, like, they earn big money. They're able to continue to consolidate. Alphabet, formerly known as Google, they are likely going to be outperforming for the foreseeable future. Now, there are breakthrough companies like Tesla, like Nvidia. Nvidia was later, right? First entering through GPUs, and it was a breakthrough company. And will there be other breakthrough companies? It's hard to do, but there will be. Is OpenAI going to be one of them? I don't know. I don't know. I don't think so. They could be, though. You never know, right? And will it be? Did Meta, by going open source with their LLMs, kind of prevent OpenAI from being one of those companies? Maybe. Anyway, what should investors do? Stay wary of herd behavior, especially when FOMO driving. Our models prevent us from this. There is nothing more important than that. The verdict, though, Mark doesn't think that we're in a bubble right now, but here, just caution. The market doesn't seem nutty to me, but high priced and fourthy, yes. And by the way, there's a difference between looking at something like a bubble, dot-com bubble, and then looking at different liquidity risks within the market. So it's not just like, you don't have to just focus on one thing. This is the market. Like, we got to have our head on a swivel and be watching our back for everything. Here are some concerning signs, though. And if you look at the equity market concentration, it stands near its highest level in 100 years. Now, again, I think, and for every reason, it makes sense to me that the so-called Magnificent Seven, right, these large cap tech growths, their earnings are insane. It makes every reason for everything to be concentrated into them right now. That could change. Again, for me, it seems correct. Now, I have to. Is the problem there, though? I'm like, when I think about that, or I look at that, is the problem with me saying that is this time is different. There we go. Blind faith. Is this time different? I mean, I'm just saying I think it could persist longer than anticipated. That's what I'm saying there. So you could see it over here, back into the dot-com bubble, looking at the technology sector. outperforming the S&P, tech outperforming the S&P by the largest margins. But again, for every reason, tech should be outperforming. So I don't really see anything wrong with that personally. So what about this? S&P 500 earnings. We're getting away from tech for 1 second, just talk about market behavior. And you could see growth stocks now account for over 50% of S&P 500s. And you could see the last time that happened, boom. And then we're in that similar situation now. I suppose I guess we weren't over there. And if you look at it in relation to this slide over here by Peter from Game of Trades, Bravo's research, you can see that what happened afterwards, you saw a complete reversion and growth stocks coming back down towards 10%. Now, it's the one thing that's different or difficult is that these growth stocks, quote unquote growth stocks, they became high earners. They became extremely high earners. Look at, for example, Facebook. Facebook had no earnings in the beginning. Look at Amazon. Amazon, no earnings whatsoever. They were just completely growth stories, growth stocks. And then they have translated into enormous earners. So that, I mean, are you still calling them growth stocks who are contributing to the 50%? It depends how growth stock is being. So I'm trying to look at this healthy from both sides. I don't think there's anything easy about it. I completely agree with this, though. The Magnificent Seven have the strongest fundamentals and are the most dynamic and changing business cycle. Think of that, beautifully put. Learning, pointed to the 2022-2003 layoffs. They learned from the dot-com bubble burst, these tech companies, and they knew the way to survive if a recession was coming was to be quick to the layoffs. What an exercise. That's beautiful. Good. God bless you, Hypernova. That's beautiful. So and we're going to continue here. I'm throwing caution out to the wind. When I was looking at this in the book markets, though, and I see this top hedge fund performance 2024. Well, this is who you're competing against, right? Over here, so you have hedge funds over here, and I would say that about 85, 70% have about 36% and lower. And this is the best performing, right? Minus 32%. And then you have a couple of outliers in the high 49s, low 50s, and then 81%, the best of the best out of all hedge funds for top performing temperature and return. I guess this is in relation over here to, right? Hypernova was putting out on buy side boost, just confirming performance, up 60% in 2024. Missed the 70% Solana trade, would have put it at 76. Phoenix Fire, the creator of the amazing puzzle of like efficient capital allocation known as buy side boost, said that, I was closer to your return in my actual count, around 70%. Beautiful stuff in relation to what is taking place there, along with, and that also serves as just a reminder, like Tesla is a great standout. Up until recently, when it just put in that 40% plus gain, it was lagging. You never know what's going to be leading and what's going to be lagging. By having that diversification, if you go into the Nuggets channel, there's a pinned video that talks about the best allocation possible. It's about a 20-minute video. It is outstanding, and it is absolutely required watching. Come back to that. So I'm just going to laugh at the comments for 1 second. And then Michael goes, yes, anything sub 100% is disappointing to me. So, and just wait until the bull of all bull gets going. There's no question about that. But just keep going over here, and we're going to come back to this in a second or later, right? When I talk about bear markets. So I'm looking here, and I'm trying to see where we're wrong. And I'm looking about the assets that CTM has honed in on and chosen. I'm not including Solana because Solana is ridiculous. So, I mean, Solana is obviously an asset that we trade, but when you put it in relation to everything else, it's, I take it off. Otherwise, it throws everything askew. I have over here benchmarks, NASDAQ and S&P 500. And looking at this and saying, are we missing anything? Now, I know that we're looking at including next MicroStrategy. And what's great about the volatility of MicroStrategy is that it works both ways. It could work both ways for us. Similarly here with NVIDIA and Tesla, right? Up or down, it doesn't matter. We attack on both sides. We have things like FNGU and TQQQ, which are just buy side only. And I'm wondering if we were to enter into a period of something like the lost decade, what happens to us? I guess what I'm trying to say is if the Magnificent Seven, or we'll just say tech, okay? So FNGU, highly correlated to the Magnificent Seven. TQQQ, highly correlated. And same thing with NVIDIA and same thing with Tesla. They're all highly correlated. They're all highly correlated. And if the Magnificent Seven were to crash and burn, like whether you're talking about great financial crisis type recession and drawdown, or dot-com bubble burst, or 1929 style depression, like if they were to crash and burn, everything, all of these are going down, right? With that in perspective. So I wanted to look at first, well, what happens if we enter into a lost decade? What were the best asset classes that outperformed? We have over here emerging markets outperformed, and then I went to the lost decade, right? I start at the bottom. This is for U.S. total stock market, and this is a lost decade. It went sideways for 10 years. Could you imagine if you are invested in the stock market, which most people I know, they have the majority of their retirement savings inside their retirement accounts. And I remember when it was like 2020, they were really upset and mad that they saw their portfolio draw down significantly, and no one gave them a heads up. Hey, listen, maybe you should reposition yourself, taking a look at the market. No one will going forward. And could you imagine, that was fine. That was 1 year, 2023, 2024. All they're thinking is that like, oh, up only, no problem here. Same thing happened during 2020 when they saw their portfolios get obliterated. It lasted a few months. It was short-lived, and then it was up and to the right. They all forgot about it. What would happen to people's retirement plans if 10 years was a lost decade? That's why it's called the lost decade. So that's stock market. You could see the S&P 500, pretty similar performance, worse, right? And then you look at the U.S. large cap equities, even worse. So it's like a lost decade. And then I looked at the best performer was emerging markets, right? So you look at emerging markets and you're like, all right, I mean, that's a little bit better. You can see the high correlation during the first 3 years. And then don't forget, after that, in this period over here, U.S. equity markets recovered up until the crisis. And then you can see the high correlation here as well. And then the up out of it. So they did much better. But this was also around the time that China was opened up to, I forget the name of the World Trade Organization. FNG. So we have FNGD, but it's very difficult. So just one thing that I want to say. Well, I want to say a lot of things. We'll keep going over here. I think the short side is very difficult to trade. And it needs to be approached a little different. Let me come over here and let me come like this first. So this is very easy to trade, or at least it was for us, no question about it. But a lot of bear markets have these like really difficult rallies that you've probably seen it a lot on crypto yourself. But look here, here's like the dot-com bubble burst, right? And I just wanted to show you the magnitude of these rallies over here. So not bad. I mean, 9%. It's not a face ripper. Another 8% rally, a 20% rally back into a bear market. Oh, I thought this would be the bull market started. 22% rally, you know, and then into the end over here, 20% rally, low taken out, another 20% rally. Point being, is very difficult. It's probably great for us looking at that price action, honestly, because we're looking at the 3-day here. If you look at the 1 day and you look at those rallies on the 1 day time frame, those 20% rallies would be fantastic for us. This would be ideal for us. This type of situation would be ideal. So I guess, but I'm trying to make it difficult. And again, over here, you can see it's only a 14% rally. Floor cut out, floor cut out, floor cut out. If you notice, though, most of our templates perform much better on the buy side than the sell side. Stanley Druckenmiller, he's a very strong advocate. It's very difficult to make money on the short side. More money's made on the upside. It is true. It doesn't mean money can't be made on the downside. It's very difficult to find short side modeling. That's true. We haven't put too much focus in on it. Maybe that's what needs to be giving and including short side only. We've never given any time and effort into sell side only. So that's something I'm highlighting right now. That's probably something that's very, very, very important for us to do. All right. But let's go with, because looking at that is all right. Well, it's not too bad for us. We'll probably crush it. But like, let's go with just the belief that the sell side is very difficult. Okay. We're just going to take that with us. So I was looking at, and we know that China's been under massive trouble trying to sit and just going with the belief that, well, emerging markets, indeed the best performer, right? You can look at things like the second and third best performer, US small caps, stellar performance. Not really. And they did much better in this. So the Russell did in these first 3 years well outperform, right? Nice performance here. Got wrecked during the great financial crisis. It's not attractive for me though, or for us. The one potentially solution that I was looking at as some type of diversification, maybe. When I talk about diversification, you could see recently the T triple Q running up, right? 2 years in a row. And then China over here, this is triple leveraged product and getting wrecked the whole time. Is it possible? Is it possible if we saw some type of like not a $6 trillion yuan, like 1 trillion US dollars, but if we were to see a bazooka from the Chinese, that we might see a deviation differently? I think so. I think that's possible. I think it's probably worth our time. And I think this is more related to T triple Q gains, not like FNGU, not like Tesla, not like Nvidia, but T triple Q gains are still solid. And if they were offering diversification on the buy side, I think it's really worth our time and effort to come up with a model for the YNN. That I do, and I think that could really be. I know MicroStrategy is something that we're including going forward, but I think that this could also be something that offers strong, stable upside returns, much like T triple Q. If indeed, let's see how it navigates this period over here. This is great modeling actually. If we could model something on the daily time frame where we had, 1, 2, 3 up waves, and then it's able to manage. Even this is a decent, but it's able to navigate this deflationary bust without getting wrecked. That's a strong template for us. That's a strong template for this is. I think it's very important that we're able to see what we could do on this collectively. The volume is there as well. It has higher volume than FNGU. So the volume is, no, I take that back. FNGU's volume is to the top. Sorry, it is much higher volume that I was looking at India's afterwards. It is much higher volume than look at this, much higher volume than FNGU. There's ample volume there. It makes a lot of sense for us to focus and look at it. But I just wanted to point out also, I think that the returns would be more, and the benchmark should be more T-triple-Q type gains. So one of the beauties here, though, about the way that we approach these markets is that, and pointed out, whether it's through T-triple-Q or FNGU, we're focused on tech, and we're focused on a asset, these ETFs, that are continually reallocating to the strongest. That's very strong and good for going forward. If you look at the bear markets in 2022, these things did amazing. This is T-triple-Q, right? Here's FNGU. They're just out of the market, buy side only, preserving all of their power. If YINN is able to do that during that deflationary bust, it's spectacular. And then you could see that during 2022 equity markets, significant gains. Here, let me go ahead and do this. This is the bear market of 2022. So you could see that T-triple-Q, nice gain. FNGU took a loss, 5% loss. Here's the performance stats. So T-triple-Q, break even on the year. FNGU, off 5%. NVIDIA's buy and sell side, 73% gain. That's, 20% on the up, 26% on the long side, 47 on the short side. And Tesla also 98% gain. And then you're looking at here, again, small gain on the upside, large gain on the sell side. So if we are to see a bust at any point, even as we're positioned right now, I think that the only thing that should be redirected is expectations. For example, if you're looking at your portfolio allocated 25 each between each of these, and you're not doing buy side boost. Now, buy side boost, and I would like to give it more of a back test, even just between these four during this bear market in 2022 with TK3's back tester to confirm. But buy side boost should take, I'm looking at this with the gain of 75%, 100%, and 0% as like a 35% gain. Okay. With the buy side boost, probably it's higher, but I don't know that. So I'm just looking at this as a 35%. Now, if we take our like getting it done expectation of 70% a year, and we dial that down if we enter into a bear market or lost decade, right? I think that might be very good psychologically to prepare ourselves. I think so. I think that's a good way to approach it. I think that if you look at what we did on crypto, a bear market would be amazing. If you're buy side only in a bear market, you're not just preserving capital. You're preserving your capital, which is absolutely outstanding. It is absolutely priceless. But if you're trading the short side in crypto during the bear market, you can see that Ethereum during that period had an incredible year. And that was both buy and sell side. I remember a 50% gain on the buy side in the summer over here. Bitcoin, more getting it done even in the bear market, right? And then you look at what Cardano had a tremendous year in the bear market. Solana wasn't developed at that point or being traded. but you could see the bear market in altcoins. Because again, altcoins, especially the weak ones in a bear market, is like the place to be. So I think that potentially, this is just pure speculation, why stock market returns in a bear market may be likely more subdued because we're focusing largely on the buy side, except for Tesla. But again, MicroStrategy might be a really good key into that as well for the short side in conjunction with Tesla and Nvidia. But crypto here likely provides, because volatility is what we kick off of. Again, the hardest portion for us was the first 3 quarters of 2023 because it was coming out of that bear market when the volatility in crypto was so subdued. Not stocks that, risk flows in to assets depending on where they are on the risk curve. That was humming. So I think we're well positioned if a bear market occurs exactly as we are. But I think at the same time, it might be smart to have a little bit more subdued expectations. Now, I'm not talking about I guess I'm talking about like the best performing in a bull market hedge fund style returns 35%, right? That would be subdued. How do I get back to that? And I think that's, well, not even the best performing. If you take like just the top, right? The top, the third quarter, right? And forget everything else. But that's a good place to be. That's what they're doing in a mega bull. And if we're able to do that in a bear, I think that's good like expectations to have ahead of time. I wanted to share this with you. V3 is a lot stronger than V2. And, this is a good, I mean, we're dealing with such strong models, and I mean the difference between V3 and V2 is actually very minor. The modeling is better, but the difference is it's not like, oh, we're entering into a new territory, got to be super cautious. Because you remember when we built V2 on top of CTM 2.0, there was initially a high degree of caution coming from myself also. Like, or is there more room here now for overfitting? Obviously didn't work out like that, but that caution was well deserved. Yeah, I think soon enough. Let's talk about Bruce. Psychology channel. Being a long time, 12 plus years Bitcoin holder, I struggled over the last year with FOMO when CTM is on the sidelines, and I sold. I am 100% sure CTM is the way to go. I'm just looking to manage emotions better. Seasoned. Beautiful. I uploaded all the CTM 2.x. This is buy side only on the 8-hour 101 trades for 2024 into ChatGPT. And I've been asking questions about the data, and I found something I'm sure but quantified it. In 2024, Bitcoin 101 was out of the market 767 hour periods, 8-hour periods, out of a possible 1,095. So 3/4 or 70%, 71% of the time in cash. That's understanding makes me much more comfortable knowing ahead of time that being in a trade is actually not the norm. Worried about being sidelined. So I've told myself we're either in cash waiting for a good entry or in a trade that is on the right side. We spend very, very little time losing. Most of the time, it's spent waiting. Another tidbit. Of the 327 hours we were in a trade, were bars that ultimately were from a winning trade. So 234 of the 3/4 of the bars were winning trades. Clear evidence of letting winners run and losers short. Nice share. CTM mastered the most important part of trading, managing risk as demonstrated through letting our winners run and cutting losers short. Our risk to reward is spectacular. What are your thoughts, though, about the role of BTC bull runs playing in this? Interested your perspective along with the data read and going back further than 224 as well. Just before I get into it myself, he said, look, I think you must understand the strategy you're deploying. Bull runs will give you that I'm in for the long term feeling. That, but my perspective was that they outperform, especially in bull runs. But listen to this. Bull runs will give I'm in for the long term feeling, and is why I'm using it for my hodl stack. Right? Well, hold on. Let's just get into it. Here's Bitcoin bull runs, and you can see that even these runs over here, when this was developed, shout out to Wes. As we're going up and to the right, Wes is like, you can't outperform buy and hold trading. And that is absolutely right. If you know when the bottom is and you know when the top is, you cannot, I say that with the asterisk, outperform buy and hold. We can, but you can't. And Bitcoin bull runs was produced in order to be able to, from a mechanical way, know when the bull run has a potential for extending out and when to be out. And you can see it really well developed over here as you look at the bear market. You're briefly in the market, you're out of the market the whole time, preserving purchasing power. Here's a bull run from the COVID recovery and in the market. I mean, how many people do you know wish that they were in and out? So anyway, yes, you can. If you go over here, you see what the performance is right now, and you look at from the bottom to where we are now, that's 246%. You look at our performance, oof. Sorry about that. That's wrong. The bull market is 417%. You look at our performance, 182%. How are we outperforming? 182 compounded with the open position is going to do. And by the way, when this closes, this is if you were able to know when the bottom was and when the top was. And nobody could do that. Most people realize the top was in after price comes off 35, 40%, as always. But if you look at the data between the two, BTC buy side 101, which is what Bruce was talking about, and then you look at Bitcoin bull runs, let's take a look at those bull markets here. So I need a little bit of room, wiggle room over here. Let's do this. All right, we can see the years here. All right, so you can see most recent, 2023 and 2024. Right? So buy side only did 76 and 45 compared to 38 and 115 with the one caveat though, right? That has an open trade 40% into profit. So I'm going to give the check mark to Bitcoin bull runs. What happens if we go back to the 2021 bull run, right? So you have 133%. By the way, this was in 2020. Buy side only was kicking off. So we add these two together. You have 200%, 91 and 133, 220. But Bitcoin bull runs did 492. Much better in the bull run. Now, what happens if you go through 2016, 2017? So 2016, 2017, you got 60%, 224. Bitcoin bull runs we got 2016, 100%. And we got to include 2018, the 840. Again, much bigger run over here. And in the 2019 run up off the low to the 14,000, 145 versus 115. I mean, or you could just look at the overall compounded annual growth, which is higher. This is factoring in 2011 into this calculations, but 79 versus 96. I think the Bitcoin bull run is better. That's why I asked Bruce to take a look at it from that psychological aspect. But it's a little difficult to argue with the the tremendous performance of buy side only. So oh yeah, so there you go. Throw it in. Yeah, and you can take a look at like us calling discretionary 17,250, and we'll see when we exit the top. That would be in the market as well from a discretionary standpoint. But that's just from calling the bottom. Isn't that beautiful? All right. Anyway, in my pushing and kicking today, making sure that we're in the right place. And even if we were to see something happen, like, for example, the current leaders of the market to crash and burn, not only the current leaders, but places that we are focused heavily in on, what would that mean for us? Are we in the right place at the right time? Could we add any type of diversification? And yes, as Ace pointed out, we can indeed for sure be taking a look at a lot more modeling on the sell side, specifically sell side only. It was brought up that maybe we could be taking a look at FNGD, SQQQ. Aldo, this is like, as far as I can see, the most heavily levered Chinese instrument, and the volume it warrants CTM could completely be focused in on it. I don't know if like it's the most levered Chinese instrument that I could find. Look, if anyone could find a better option, then that's a good thing. The takeaway here is I think that us looking to model a potential diversification option and be going with the Chinese tech, right? The best instrument there. I think that NVIDIA, Tesla, and soon to be MicroStrategy clean up on the sell side. If you're buy side only, you're not only protected during all of this, you're on the right side. What I guess I didn't look at over here, well, I could do it easily now. So we looked at the sell side or all of our positioning. Let me take off the sell side during the bear market in 2022 of NVIDIA and Tesla for someone who's buy side only. So 16% in NVIDIA, 23% in NVIDIA, loss of 5% in FNGU, and break even on TQQQ. So now you're talking about a return of like 10% if you allocate a 10% return buy side only during the bear market. Most people had to recover from the 30% loss, and to recover from a 30% loss took over a 50% gain. So during a lost decade, not during the lost decade, because during the lost decade, there are plenty of times when you have the rallies. For example, this is obviously 3 years of downward price action, but this is then 4 years or 5 years of really strong, 4 years of strong price action to the upside and over here. So it wouldn't be like lost decade if you're trading CTM. The returns would be subdued. And then we looked at the NASDAQ in 2020, 2021. They were massively strong, rip-roaring rallies, and our models would actually be cleaning up during those periods. We would thrive in that volatility. So I suppose in doing this check, having this conversation today, I feel actually a lot better, more comfortable than the direction that we continued in. If we were to see a drastic change in the market, where we were to see something like these crashes that come after those large concentration and positioning, I think that we would withstand it very, very well and continue to thrive. So I think that we could do better in two things. Number one, looking for a potential diversifier. And number two, and I looked at India, the volume is not there and the returns are not there either. The other thing that we could do, as mentioned earlier by Ace, is spend more focus and time on sell side only modeling, and maybe that opens up the door for even things like FNGD. FNGD during a period of turmoil. Gotta take this off. So we only launched in 18. So we don't have, well, here's the fourth quarter. And let me go like this. 50%. 50%. Oh, sorry, I went the wrong way. Let me go the other way. Sorry about that. FNG do. We're buying when it's going down. So you take the fourth quarter and 100% run up, there was money to be made during the over here. 70% gain to the upside during the crash. 150%. What happened to the bear market in 2022? There we go. Not much. That's hard on a daily. It's better on a short time frame. I mean, what's the 3-day time? I'm sorry, that's a 3-day time frame. Sorry about that. So, is the bear market of 2022 like the most ideal place for us to be modeling on? And then also, the we never done something like that. Modeling on the second, the third and fourth quarter of 2018 and all of 2022, just in those two spots, and then trying to combine, or do we model in all the data and hope that it shines during those two periods? I'm not sure. I'm trying to throw it out there. Maybe we could do better on FNGD on GD, and maybe that could become the other piece that we are needed, as well as maybe there's another instrument out there. This conversation needs to continue. I'm only able to point out two things with clarity. I think that we need a potential Chinese diversifier, as pointed out. And then I think on the YINN, I think that we need to look at sell side modeling and then potentially see what's going on here with FNGD to see whether or not that's something that fits the bill. This is all important. Let's get into it. Let's continue going. Everyone, awesome session. Thanks for being here. God bless you all. I'll see you now on the inside.